simplify your options trading using proprietary automation. We're going to learn how to collect option premium in a completely unique way without screen watching and babysitting your trades. We've got pre-built option spreads, automation for risk and profit controls. We'll talk about hedging strategies as well as simply speculating with directional and non-directional strategies. And we're going to show you the most unique trade alert that you've ever seen. These are one-touch trade alerts, make your life a lot easier. So that's the whole idea here. And we'll go ahead and get started. Remember, we are speculating and we're trying to make money. The whole idea is to take risk and try to profit. But of course, as I mentioned, there's always risk when you're trying to make money. So do take a moment and look at the risk disclosure. It is important. Okay, all funds committed should be risk capital. Past performance is no guarantee of future results. So keep that in mind. A little bit about AltaVest. Since 1997, we have been a registered introducing brokerage firm, over 25 years of experience, trading tens of millions of contracts over that time period. There's some of our colleagues, that's yours truly there in the middle. And we're down on the trading floor, the S&P 500 options pit. And we're a futures brokerage firm, and keep in mind we're highly regulated. Operations are audited at least yearly, so that is to your advantage. You're working with a regulated entity. We're registered with the CFTC and a member of the NFA, and we're located in California. A little bit about myself. I'm Eric Gebhardt, been doing this about 30 years now, and I have my BS in Business Administration from the University of Southern California. And I started back in 1991 is when I first was licensed with my Series 3 commodities license. We do presentations, especially since the pandemic began, a lot of online presentations. Of course, we did things in person as well. So maybe you've seen some of our materials in the past. And if not, hopefully you're in for a bit of a treat, something new and exciting that you've not seen before. I began in mutual funds and annuities and insurance products, and had my Series 6 and 63 securities licenses, so that's the environment where I started. And then I moved into the commodity future space, which is, of course, what we're going to talk about today. I also have my Series 65. That's our investment advisor law exam. All right. So with that said, I think what I will do here is give you a little more room on the screen. I'll turn off that webcam for the moment. Okay, I like to kind of keep it on during the introduction, but let's talk about 3 common barriers for traders. And feel free, I want to encourage you to ask questions. Use the chat field there, the questions. I can't get to everything right away, but as you think of something, just put it down. I need that feedback. And also, I'm curious, which one of these 3 barriers to trading can you relate to the most? So how do you actively trade in this environment, or really any environment? What about day trading or stock picking? What do you think about that? Trading the chop, as you might call it, with individual stocks or individual instruments or ETFs or whatever it might be. You know, trying to sell the highs and buy the lows. Not that easy to do, folks, and we're not going to try. So we're going to look at a different approach. We're not going to try this at all. And part of the reason is, according to some studies here, day trading, less than 1% are successful. So trading is easy, and we'll look at day trading real quickly. Here's an article here. Less than 1% of day traders were consistently able to beat the market, and 80% actually lost money. Another study out of Charles Schwab, most active traders substantially underperformed a simple low-cost index fund. Here's another study out of Brazil. 3% of day traders made money, less than 1% made more than the minimum wage. So you get the idea. And I know some people can do it and make a career out of it. And on the other hand, a lot of people just don't have time. They have other things to do during the day. And what about professionals, managers, stock pickers? Well, they even struggle. Look at 2021, 79% of active fund managers underperformed. And over 10 years, 86% of active fund managers have underperformed. Goldman Sachs here quietly lost $2.6 billion investing in stocks in the past 4 quarters. Look at BlackRock breaking all the wrong kind of records. They lost 1.7 trillion in the first half of this year. So if it's difficult for them, you know it's difficult for all of us. So how do you actually, you know, sit in front of the screen, or do you want to sit in front of a screen and make this work for you? What about social media? Social media stars are moving the markets, but remember, being popular means you're never criticizing and you're essentially always bullish. But this is kind of scary. 2/3 of adults who have been investing for less than 3 years use social media to make their stock trading decisions. So they might listen to a guy like this. He says here, in real estate, you can make money out of thin air. And he kind of goes into how he makes $100,000 out of real estate out of thin air. Here's another guy here, says you can make 750K pretty easily, according to him. So do you believe that? I don't think we should. But remember the day trading that began in the pandemic? Bloomberg says all the people day trading lost all the money that they made in that meme stock era. It says here, the amateur investors who jumped in when lockdown started gave back all their once prodigious gains, according to Morgan Stanley. So here's a kid here. His parents gave him 500,000 to invest, and now here's his result. So who knows if this is true, but regardless, we want to avoid this, folks. So maybe we can look to other people we see on TV. How about people, pundits like Jim Cramer? Yeah, I'll pick on him for a second because he's such a high profile person, or, you know, the ARK Innovation Fund. March 25, Jim Cramer says the bear market is over. So just this March, what is that, like 5 months ago, 4 months ago? So here's the arrow when he said the bear market is over. And actually, that was the beginning of the bear market. So Kathy Wood, she says, we think the bottom occurred on January 27. That's when she said it here. And of course, since her innovation fund has just dropped and dropped and dropped. So maybe it's not a good idea just to listen to what people on TV say. Or what about crypto? Everyone's into crypto, or at least they were. Well, here's the performance of Bitcoin. You can see here. How about this one crypto firm here? Uprise lost 99% of their customer funds. This other, what, 3 Arrow was it? I think they went bankrupt. The owners, I guess, fled the country. They lost something like 10 billion. So that's all kind of narrative trading. I guess my point is avoid the narratives, avoid the storytelling, avoid the people on TV and radio, you know, pitching their book. But how can you then trade, even if you are if you are trading, how do you then beat the market? Well, it's not that easy to do, folks. Here's a economist, Mark Skousen. They ran these hypothetical portfolios, kind of, they call it the monkey portfolio. So 96 of their 100 monkey portfolios beat the generic cap-weighted index and outperformed the benchmark by 1.7% per year. So kind of randomness is what they're saying. Either that or there's your best hedge fund manager right there, folks. Okay, here's the third one. Here's the third hurdle. It's just us, our own emotions. You got to control your emotions. It can be expensive convincing the markets that you are right. Completely agree with that one. You don't want to end up like this. And you want to stay off that roller coaster of emotion, that market cycle of emotional ups and downs, the euphoria when you're winning, the despondency when you're losing, and optimism once things go your way again. So again, we are the worst financial enemies, according to Motley Fool. We've got confirmation, anchoring, and recency bias that we're all susceptible to. And this one image, I think, might sum it up best. When things are going well, we tend to think we're pretty smart, don't we? It's even after 30 years, sometimes we fall into that trap ourselves. But remember, the algos are really dominating the landscape. They have no emotion, no bias. They're basically relentless in their pursuit. They're dominating the landscape. How much of trading is algorithmic? JP Morgan says 90% of the US equity trading volume is what you call machine-driven, algo trading, computer trading, whatever you want to call it, AI. So that's called revolutionary trading. that's a clever little cartoon there. Here's a little grainy video I took years ago visiting the NYMEX trading floor. So that's how it used to be. And this is what it's like now. This is your competition. This is our competition, actually. No emotion, automation, built-in controls. And it's sort of like a methodical approach to trading. We use systematic trading, and similar to how some of these large institutions and maybe an insurance company might trade. Let's look at an example here, how an insurance company trades and how we can trade options, perhaps just like they are running their business. They're paid premiums to assume risk. They sell and manage time. They insure themselves by hedging. And they're consistent and they're patient in their approach with their business plan. And they look at math, probabilities, statistics, actuarials. You know how they do it. They're just number crunching, looking at data. So they're using math to help them along the way. But so how can we do something similar with premium collection, or how to collect option premium, just like an insurance company collects premium? So we call these basically base hits by going short with options, being consistent and patient, and managing that risk, expecting to have losers. Absolutely, got to keep that in mind. And manage your reward, that's just as important. Don't get greedy. But you need the proper tools to make this happen. It's easy to talk about it, but how do you actually implement this? So remember, base hits, we're not swinging for grand slams here. These are short option strategies, premium collection, non-directional, bullish, bearish, it doesn't matter. There's strategies for all those conditions, and all the targeted outcomes also have predetermined risk. And these are called credit spreads. These are insured positions. Again, your risk is predetermined as the reward is. They may be non-directional in nature. And we're going to look at stock futures index options versus individual stock options. That's kind of a mouthful, but I'll show you in just a second. And the reason why, these are three big advantages. First of all, an index is always less volatile than an individual stock. Two, an index, it's easy to implement strategies for any particular direction, and also you might hedge your portfolio using an index or the overall movement in the market. And then if you're trading one or two indexes, you're really just looking at one or two markets, not, I think there's 6,000 or 7,000 securities markets. So much easier and more convenient to track. And then here's an advantage of credit spreads on these stock index futures options that we talked about and the way we do it. Don't worry about this graph at the moment, but all you need to know is here's the underlying stock market moving up and down, up and down. Here's the upper boundary of the trade with your calls, and here's the lower boundary of the trade. So really, you have a wide margin of error on this particular strategy here, and we'll show you how that works. But first, a couple quick review here, quick review on the Greeks. We'll look at just two of them. Determining probabilities using delta. So that means how much does the value of the option change based on the change in the underlying index. It's also the approximate probability of expiring in the money. And here's an example. If the delta is 0.25, that means there's a 25% chance it expires in the money. But conversely, and this is how we view it, that means there's a 75% chance it expires worthless. And remember, delta is always moving with price and time. It's not static, and it's not the probability of a winning trade. So keep that in mind. That's an important point there as well. And theta, the only other Greek we need to look at today, time decay. That's what that reference is. Options are limited in their lifespan. So theta is a negative number. It equals 1 day of time decay. So if an option's at 10 points and theta is negative 0.05, the next day the premium would slip to 9.95, and the next day after that 9.90, and so on and so forth. And this is what it looks like on a graph. As you approach time zero, the percent of the premium remaining on that option drops and drops and drops based on theta decay is what they call that. So that's the reference to basically options losing value as time diminishes. And if you're only buying stock options, remember theta decay is working against you. So this is a video I saw just recently, and I thought this woman summarized it very well. So here's the title of the video if you want to look at the whole thing. But I took a few screenshots here. It says the appeal for a lot of retail investors to buy options is that they're much cheaper, but your potential for profit is actually not that high. An option spread calls for buying and selling different contracts, and it's a very common way for investors to hedge risk and volatility. And it's usually cheaper because you can offset your cost by the proceeds from different contracts. And it's been used by Wall Street professionals for decades. In 2021, 11% of Robinhood active users made an options trade, and of that, fewer than 1% actually made a multi-leg options trade. So what she's talking about, folks, is your typical retail investor is just buying calls or maybe buying puts. That's all they're doing. So let's look at how professionals are trading options. What are some of these professional options strategies? Well, she talked about multi-leg strategies. For example, selling a call spread. You sell this out of the money call here, that's the red line. You collect 4.5 points. You buy the blue line, that's the 45.70 call, and you pay 2.25. So the net result is you collect 2.25 points, $112.50 in this example, minus your commission. So that's selling an out of the money call spread. So you hope the market essentially stays below this this red line, essentially. And then you get to keep the most of that premium or all of it, and we'll show you how we do it. Same thing with selling an out of the money put spread. You sell the 36.60 put, you collect 3 points, and then you buy the blue line there, you pay a point, and the net result is 2 points that you collect, put in your pocket. $100 is what that represents in that example. And of course, you have to take into account your commissions, and we'll talk about that later too as well. And remember, these are not naked options. These are all covered strategies. Your maximum risk and reward is known in advance. So these are called covered option spreads. And if you're trading naked options, I would highly recommend and suggest, how about strongly say that don't do it. It's going to work maybe for a long time, and then when it doesn't work, you're going to, end up giving everything back. So we don't want any naked options trading. Keep yourselves covered, as they say. And here's another advantage. There's no margin calls when you trade the way we do. And of course, there's no unlimited risk when you trade the way we do. So here's an iron condor. It's a non-directional strategy. You collect premium. It's simply the put spread and the call spread at the same time. So what you just saw, and here's what it looks like on a graph. You sell a call spread, you collect the premium, and simultaneously sell a put spread and collect the premium, and you look for the market to stay in this wide range. Now here is our weird proprietary strategy. So we'll reveal that to you here. It's really a called the Dragonfly, something we came up with years ago. It's 6 legs to collect premium, and it's really a variation on a Condor. And here's what it looks like. And let's break this down. I'll show you the structure here. You start out by selling 4 of these calls. You buy 3 further out and 1 closer to the money. And then the same structure, selling 4 puts, buying 3 further out and 1 closer to the money. And you do this all simultaneously. And you'll notice that the call you buy here, in this case, is 50 points closer to the money than the others you sell, and the same with the put. This put that you buy here is 50 points closer to the money than these that you've sold, and that creates a completely different risk-reward dynamic compared to any other type of, like we saw the Condor, or kind of that 1-to-1 ratio kind of with the other trade structure. And I'll show you in just a second here how that works. We've also got some unique bearish option strategies. You can just do half a Dragonfly. So going back, you can just do the call side of a Dragonfly, just like that. Here's an example. Here's something we call the bear hedge. It's probably better just to show you here. Very simply put, you are selling an out of the money call spread, and with the money you collect from doing that, you buy an out of the money put spread. You can typically do that for even money and sometimes even a credit, so the trade doesn't cost you anything. So there's a lot of ways to do this, but if you're just as confused as Jackie Chan, which market to trade, which strategy to apply, at what price, what's the timing, how do you then manage the position for risk and reward? So we have automated options technology. Let's look at that here. It's called Theta Trader. These are pre-built option spreads from our proprietary algorithm, creating what we call theta trades. So advanced strategy automation, all market conditions, and then automated risk and profit tracking, something called the risk thermal indicator. And we'll show you that here. We're going to jump into the demo here. So our software here, it's a simple, effective option spread trading, and you have profit and risk management that you can also automate if you choose to do so. And we'll show you how that works. Okay, folks, let me switch screens. Before I do that, let me do something real quick. Bear with me, folks. Got to pull up my other screen. It's formatted wrong, so give me 10 seconds, and I'll have it all set up. Okay, there we go. Now we'll switch over. Okay, so now you're viewing the Theta Trader dashboard. I just wanted to confirm that you were seeing what I'm seeing. And I see the comments and questions coming in, so keep them coming, folks. Yeah, I see a lot of good comments coming in, so keep them coming. So anyway, I'll get to a lot of those questions and comments, but first let's jump in here, and maybe I can expand this, make it a little easier to see. So you'll notice the theta trades here. You'll notice your open short or sold positions and open long or bought positions. You'll notice your account info, and this is pulled all directly from your AltaVest trading account. So everything is integrated with your trading account. Of course, AltaVest, we are the brokerage firm, and this is our technology, Theta Trader. So as our client, this is what you would be using. And we'll just jump in here. You can see bullish, you can see bearish, you can see neutral strategies, and they're all pre-populated here. And then you'll notice we're trading the Emini S&P 500, NASDAQ 100, and Russell 2000. And again, I'll show you the advantage to that in just a moment, but these are the markets we're focusing on. And you'll notice the iron condors and dragonflies. The algorithm has generated these trades for the day. So anywhere from 16 to 53 days till expiration. Just a second here, folks. I want to make sure my mouse isn't giving me any hiccups here. And I just changed the battery too. So we'll go ahead and look at this here, the 53 days till expiration trade, your September end of month. You can see it's already pre-selected for you. You've got the 36.30 puts and 45.70 calls. You see the profit potential here, $116.50. And then your targeted annualized return. Keep in mind that number here is just to compare one condor to another. You cannot expect to generate these types of annualized returns. So it's really to compare one trade of a certain duration versus another. But we'll click on this September end of month position here or trade. First thing I like to do is look at a chart. So here's a helicopter view. Here's the call spread. Here's the put spread that you're selling. And here's a table. I won't go through every detail here, but you'll see the days till expiration, settlement value, premium collected, your commissions, your cash required, profit potential. This is targeted return on cash, and then your targeted annualized return. And then here's your maximum profit potential at expiration. And then you'll see the strikes are pre-selected for you. The algorithm has chosen the strikes for us. And it always defaults to a quantity of 1, but you can change it, of course, and it changes all the numbers accordingly. Always defaults to a sell because you're selling the Condor. You want to collect that net premium, and we can leave the default settlement value there, or you can change it if you want. But I want to point out a couple things. The put that you're selling has a delta of 9.82. So that means there's over a 90% probability that this option would expire out of the money. And the call you're selling has a delta of 6.94. So that's over a 93% probability this call will also expire out of the money. So that's the math, that's the probability there. And let's go down to a quantity of 1 just to make it easy. So what you can do here is people will sometimes point out, well, my profit potential is not that high, and I'm putting up $800 and some. Yes, that is correct, but that's the whole idea of this this type of strategy, because again, the deltas indicate there's a high probability that these particular puts and calls would expire out of the money. So that's just simply the math, sort of like an insurance company looks at the statistics and the math, and that's what the algorithm is doing here as well. And with that said, you can go ahead, we'll do a quantity of 2 of these. I just randomly place trades in my demo account and when I do these presentations, and just assumes you're filled because it's a demo. And it works just that easily, folks. And let me go back to the dashboard. I'm going to show you a really unique feature. You can go backwards in time, sort of a time machine for trading these 4- and 6-legged option spreads and 2-legged option spreads. Before I do that, I want to show you a Dragonfly. And again, this is just on the dashboard homepage. And you go to Dragonfly. We'll do another Emini S&P 500. Let's look at this week 3 October trade. And I'll point out a couple things here compared to the Condor. First of all, look at the graph. So here's the calls, here's the puts. So you see this wide margin of error between the calls you're selling and the puts you're selling. You have over 1,100 point difference between the call and the put. And you'll notice the cash required is 4,500, your profit potential is 478, targeted return on cash 10.5%. And that's typical compared to a Condor, where your potential for profit isn't going to be as high with a Dragonfly on a percentage basis. And that's because, remember, you pay money to buy this option here and you buy this option there. So you pay money for that, and it's sort of like buying additional insurance. But it does provide some benefits. It creates a more robust trade, and I'm going to show you that in just a second. But again, the puts that are being selected and the calls that are being selected in terms of the ones you sell, you've got a 9.9 delta and a 6.5 delta. So you're talking over 90% and 93% probability the put and the call, these puts and calls will expire out of the money. And again, we'll just go, you can change the quantity if you want, but you see how the cash required moves up and down. We'll go ahead and just do 2 of these, try to sell this for 11.25 points. And just that simple. Now let me jump and show you the trade simulator. And I've loaded some trades in advance to save time. So you would reach it by going here under simulator. Let me squeeze this down. Yeah, that's better. So here's an iron condor. It's the end of month April expiration from March 1st of this year. And when the trade was placed, it had 60 days till expiration. And we can use these buttons here to play the chart, go forward in time, go backwards in time, use a play button day by day. So you can see here day by day, the RTI is green. That means good, do nothing. And I'll explain that a little further. You can see the trade, the P&L is turning profitable. So the market's kind of bouncing around and the theta decay is starting to work. And then it turns blue. What does blue mean? It means take profits. So the algorithm has decided this is the time to take profits. The trade has matured enough. So with 29 days remaining till expiration, you had a signal to take profits. And I can also point out, and I'll show you that you can automate this. Again, we talk about automation so that if it turns blue, you don't have to be watching your screen. The order can be placed for you automatically to close out that trade whenever it turns blue and gives you a profit-taking signal. So you got into this trade with 60 days till expiration, and about a month later, it matured enough, and you're able to close that one out. So we'll look at, that was a Condor into month April. So here is the same expiration into month April, and it's a Dragonfly. So let's assume you did a Dragonfly on that same day. Now this is unique. Look at this, you get a blue profit-taking signal with 40 days till expiration. So about 10, 11 days earlier compared to the Condor. And that's one of the benefits of a Dragonfly. There are many times where, depending on conditions, the Dragonfly will mature enough and more quickly than a Condor so that you have an opportunity, and the algorithm says, to take some profits and move on. So that is a big advantage at times for having this extra call that you own here and this extra put that you own right here. And the difference between the calls and the puts isn't always going to be 50 points. So again, the algorithm makes that decision. Let's go here and take a look at this one. This is a bear hedge. Don't pay attention to the colors so much on the bear hedge, but just wanted to point out that you know, if we go back in time and you decide you're bearish, you could sell this call spread and buy this put spread, and then let's see what would have happened. Of course, the trade's profitable. You see the green P&L there. So you could, of course, decide to close it out at any time you wanted, or you could just hang on to it. I don't know exactly what happened here on this one, but well, this one actually worked out, reached a maximum gain here if you just held on to it. So there's an example of a bear hedge. Here's another strategy you can use. You can just do half of a Dragonfly. We talked about that briefly. So you could just do a call side of a Dragonfly or just the put side of a Dragonfly and collect premium depending on your market outlook. So here's what that might look like, and that gave a profit-taking signal with 49 days till expiration. Said that's enough money, move on. The trade is mature enough. And here's another Condor. Let's run through this. Now the colors, I'll explain those here. Yellow means slightly elevated risk, and orange means even more higher elevation and risk, but still don't do anything. You can see the trade was positive and then it went negative. but Theta Trader says don't do anything. You can see the markets ran up pretty high here and got a little close to your upper boundary, and that's why you ended up with that yellow and that red RTI. And then eventually it turned profitable with 7 days till expiration. And then we'll run through the Dragonfly on that same day. Instead of a Condor, you did a Dragonfly. And this is what I wanted to point out. This Dragonfly matured with 34 days till expiration. Had you been in the Condor, you had to wait almost an extra month before that trade matured enough. So that can be a big, big advantage, folks, having a Dragonfly versus a Condor. You have those earlier exit opportunities. You can get out of a trade and move on to your next trade. And I think I wanted to just kind of demonstrate the red RTI. So again, you've got some yellow, some orange. Your trade here is underwater because the market immediately ran higher. It's getting close to that upper boundary. But still, do nothing. You're kind of flirting here with having an exit signal. So trade is underwater. And then you get that red loss. So this is a Condor example where you end up taking a loss, and the red RTI, again, can be automated so that if it turns red, you don't have to watch the screen. The orders are placed automatically for you, and the trade is closed out. So that's your December end of month Condor. And how about the December end of month Dragonfly? So would the Dragonfly have made any difference? Would it be more robust and been able to avoid that loss? And the answer is no. You still end up taking a loss right here on that day. So I wanted to point out that even a Dragonfly, can come under pressure and issue a trading loss. So that was the idea in showing you that. Now let's point out that under your account settings here, this is where you would go to automate your risk manager and the profit directive. So again, if it turns red or blue, whichever is first, you're going to be out of that trade before expiration. So you want to activate these if you want to automate that and then save your settings. I also want to show you we have a great help file, and that will explain the color coding on the RTI. We're not going to go into all the details here, but it's all written out right here for you as to how that works and how it's all triggered. And then there's video tutorials on Theta Trader, as well as educational tutorials here if you need some review on options trading. Then we also have proprietary research. And then I'm going to show you in just a second the best feature of all regarding Theta Trader. But I want to show you this first. So this is our daily trade scope. This goes out some technical analysis and then what to look for, kind of forward guidance, kind of some Fed watching tools there. And then we also do the daily trading summary. So that's a narrative having current price quotes and what's happening in Asia, in Europe, in the US, what to look for ahead, support resistance zones, and an economic calendar. So that's a great review. You can scan that. So people like to lean into these daily comments and research here to help inform them. And then just going back to the dashboard, and I'm going to jump into the best feature of all. And now you can notice here, these are my open short positions, open bot positions, and that's just a function of my demos that I run, just randomly picking trades. So I wouldn't make too much of these results one way or another, but you can see all of your open positions right here on the dashboard, or of course, you can see them all here on one page. If you want to do it that way, that's fine too. Takes a second here to pull up all the data. So people like looking at all this on the dashboard or here just because, you know, the color coding helps you realize what's happening at a glance. And, you know, perhaps you want to know more about this one trade here. So let's click on it and you can kind of go backwards in time. And you can get a quick review of where the market was when you placed that trade originally. And here's what it looked like when you placed that trade. Here's the trading activity since. So we're running up pretty strong here, getting close to that upper boundary, but still, you can see the trade has been kind of going back and forth between profitable and unprofitable. Now it's sitting on an open loss, but still Theta Trader said do nothing. And you can see today we're getting a bit of a pullback. So theta decay is probably going to start to work very well on just a small pullback in price. So we'll see what happens on that. But that's just a general overview of how to look at your dashboard and so forth. But let me jump over. Let me switch screens here. Okay, and I see some more chat and comments and things like that. So please do ask questions along the way, but I think I'm going to answer a lot of questions as we go. So how can we make it easier? Make sure you're viewing the same screen I am. Yep, you are. Okay, trade alerts. And these are quite literally 1-minute responsive trade alerts. You simply touch accept or reject, and that's all that you need to do. And the reason why is our technology has integrated these trade alerts and with your trading account. So once you touch accept, the order is placed. All you have to do. So here's what it might look like. Not the best example. I should probably get another demo here where I zoom in a little closer, but so you'll receive an alert and you'll get a graph and you'll see the example here, a description of the trade. You'll see the net premium being collected, the cash required, and maybe you can't see it, but the quantity is already selected for you. In this case, it says sell 5. And here's your days till expiration, targeted annualized return. And these trades are tailored to you and your account. So if you like what you see, you just touch accept. If you don't like it, touch reject. And that's it. That's all you have to do, folks. Now, let me jump over. You can take a quick look here at the 12-month history, kind of our trade alert log. But do take a moment to read this, a disclaimer. Okay, and with that said, so these are starting back in July of last year. You can see the green highlighted trades are the winners. This blue is a neutral position, no win, no loss, and the L would be for a loss. And as we go through this real quickly, I won't dwell on this, but I want you to notice that most of the trades that are colored red, the red font, are sells, meaning you're selling a Condor or a Dragonfly or a call spread or a put spread. You know, most of those are going to be your winners, and that's what we talked about with those high probability, at least mathematically speaking, statistically speaking, outcomes where you have options that you're selling that have a higher probability of expiring, much higher probability of expiring out of the money. So a lot of the trades that might end up being a loser, here we bought a gold call spread and that one didn't work, or this was part of a bull hedge, this here. So just because it's a loser, It doesn't mean it's necessarily a bad trade that you shouldn't have done that. But so anyway, you get a good idea. We're not going to go through all the details, but here's a Dragonfly that did end up being a loser. Here's some streak of winners here. Lots of winners, one after another here. Again, one of them actually is buying a spread here and another long option spread. And then here's a bull hedge that worked out as well. So we will occasionally send out alerts that have long option strategies. The good news about a long option strategy and the way we're trading them typically is your risk is very minimal. So here's a put spread that didn't work out as a losing trade, but the loss is very relatively small. Same with on this Emini S&P spread here as well, and so on and so forth. But this gives you a good example of the trade alerts and the history going back about 12 months. Here's a big streak of winners. Actually, that's a pretty good streak there. And you'll notice they're all selling strategies. You're collecting premium the whole time. So month after month after month, that worked out pretty well there, a good streak. I think it might be one more page, then we'll have to update August results here later this month. So there you have it, folks. That's the log, the trade log for the alerts. And now, how do you get started? How do you get involved? Let me show you how to do so with our Theta Trader membership and all the benefits. And here's what you get. You get access to, of course, Theta Trader and the software and everything you just saw with all of the Theta trades, the risk thermal indicator, the trade simulator. That software is valued at over $3,500. And then, of course, you saw the one-touch trade alerts. These alerts are totally unique. They're fully integrated with your trading account. So all you have to do is touch the green accept or the red reject. So they'll come on your smartphone, your pad, whatever it might be. They'll also come out to you via email as well, so you can respond via email. And these alerts, again, are integrated with your account. And once again, once your trades are filled, you can have the automation of the RTI automatically managing those positions for you. So if it turns red or blue, whichever occurs first, you're going to get out of that trade. So those alerts are valued over $4,400, most unique alerts you've seen. I've never seen anything like it after 30 years, that's for sure. The alerts I know of are a mess. People send emails or they'll send a text and you have to log into another platform and try to copy everything and transpose it correctly. And it's very clunky. It lends itself to errors. So again, Theta Trader software with the alerts, over $8,000 value. And here's really, I think the cherry on top is the private coaching that you have with us. We're completely unique. We're not just an online only platform with a bunch of chat bots. You have someone who's going to work alongside you, discuss your trades and your strategy, and someone who's experienced, who's licensed. That guidance really is invaluable. It's at least a $7,500 yearly value to have sort of that private coach. That's all part of your Theta Trader membership, valued over $15,500. And just to get a little corny, remember we talked about our proprietary research, valued over $2,900 with TradeScope and our daily trading comments. And you have access to those online tutorials as well. So you'll have that in your hip pocket if you need a little extra help. But quite frankly, it's very user-friendly, very intuitive. You probably don't need any tutorials. But to summarize your membership, Theta Trader and the alerts, along with your private coach and the research, over $18,500 value. That membership retails $29.97. If we do in-person events, it's more like $4,000. But we'll give you a much, much bigger discount than that because it's a live event. We like doing these live events and getting the feedback and kind of rewarding people for showing up live with us. 80% off, and it's only valid for a limited time. It's a lifetime membership one low payment of $597, and I'll stress that's a lifetime membership, one payment. And here is the link, cf.altivest.com/TT. So what I like to suggest is take a screenshot of this page, and that's my direct phone number. And you can call now and it'll go forward to somebody who can help you if you have questions, or it might go to my voicemail, or later you can call me or just go right to the page and sign up. That's what people often do as well. And here's the real benefit, folks. You have no excuse because there's a 30-day money-back guarantee on that membership. If you sign up and something happens in the next month, you can't move forward, that's fine. Let us know. We'll just rebate that membership fee right back to your card. No trouble. We're not twisting your arm or anything. That's not our business. We've been doing this for, well, 25 years now. So I think that says a lot. So a few FAQs. Tax efficiency. You can lower your combined tax rate on your trading by over 10% because they are tax efficient when you trade with us compared to individual stocks. Here's an example. I won't go through the full math, but if you are trading individual stocks and you're in the higher tax bracket, in this example, you'd have a 12.6% return. If you're trading with us, and the same example with your return, 20% return, you'd have a 14.64% return. And that's because of the tax advantaged treatment of the account. You have that 60-40 treatment where 60% of the gains are taxed at the more favorable long-term gains rate. Then there's no more itemizing when trading with us compared to trading individual securities. But always consult your tax attorney or advisor. We're simply not tax advice in that business, but let's see, getting a bunch more questions here, so let's see if I can get to those in just a second. Okay, let's keep moving here. I want to answer your questions. IRA, yes. You want to contact us for any details on that, but even Forbes says you ought to consider investing in alternative assets through a self-directed IRA. Absolutely, we get that all the time. And again, why the E-minis? Well, they are liquid, efficient, and cost-effective. And the E-mini S&P 500 outtrades all ETFs around the world by over 2.5 times. So the mini can be huge, sort of an oxymoron there. And you'll see here, for example, the E-mini compared to the SPY, almost 10 times greater in terms of the average daily dollar volume. And 5 more reasons to trade these S&P 500 options: volume, liquidity, access, and that means you get superior execution, at least according to this research article. The ES options offer a cost savings of $4 to $15 per contract. So that's what they mean by superior execution. You get those tight bid offer spreads. Large market share, you have densely packed strikes, 100 annual expirations, so you get that granularity and coverage. And what do I mean by that? Well, here's an example. Here's some calls and puts on a, let's say, a Condor or a Dragonfly. Then as time goes by, you do another Dragonfly with different puts and different calls. And then more time goes by, you do another set of trades. But of course, the algorithm that we use is searching for the strike prices and the expirations, and if they don't exist, it can't find them. But when you're trading in these deeply liquid markets, the algorithm is going to be able to typically find the strikes and the trades it needs. And this is very important. I'll pause for just a second here. When you're doing an E-mini spread with us, for example, a Dragonfly, and you're trading with Theta Trader, that order, and you just saw in the demo, that's placed as one order, one trade at one price. You are not legging in. If you try to do a Dragonfly trading stocks, you can't do it in the same way. You have to break it up into 2 separate spreads, and you have to leg in to both spreads, and then you have to then manage it. How do you manage it on the way out? It's very, very inefficient. So this is the right environment to be doing these types of strategies. And here's that woman again from that CNBC video. She's talking about the retail stock options traders. Most retail investors only have access to the most basic call and put options. They don't have access to option spreads or other more sophisticated strategies. So remember, with us, you do. You have these six-legged spreads, and these kind of strategies are typically done with hedge funds and CTAs and institutions and prop trading groups. So you have access to that in a very user-friendly environment. More advantages, we're only tracking just 2 or 3 markets, not thousands. Margin is efficient, and there's a clear cost structure. There's no hidden cost with what we do, such as in the security space where you have, I'll talk about that payment for order flow, but again, everything trades at the CME Group, the largest futures exchange in the world, on their electronic Globex exchange. So every order trades in the same electronic exchange. Nobody's selling your orders. No, none of that payment for order nonsense. There's no quote free trading, which is really just another word for commission. So payment for order flow, I won't beat this one to death, but that's the hidden cost of what they call free stock trading when you're trading stock options. Payment for order flow. Robinhood says they're commission free, but it means their customer orders are executed at prices inferior. And she even says the most popular trading apps generate a lot of revenue from that payment for order flow, and they can make more money from options than regular stock. So she's talking about trading stock options and the payment for order flow mechanism that's in place there. So she says there's an incentive for these stock brokerage firms to lure investors into trading these types of strategies. So with us, none of that applies. That's my point. So, Robinhood and all these other free stock trading places, they're not free, folks. They get fined and they get, they offer inferior execution, but this is a good way to sum it up. People try to save a penny, but they're really losing a nickel. David Einhorn says if you want the broker to work for you, pay a commission. All that payment for order flow and the free trading is just disguised commissions. Nothing of value is truly ever free. So yes, our commission rates are 5 1/4. That's round turn all in. And everything on Theta Trader is net of all fees. Want to point that out too. And here's a screenshot right here. Just I took from a big box brokerage firm. You can see here 2 1/4. That's what they say they charge for options on futures. But that's only per side. Then they add more fees on top of that, clearing and exchange fees. Ends up being more than what we charge. So our rates are very competitive. What's the performance of Theta Trader? Well, it's self-directed, so every client uses it differently. Everyone makes their own trading decisions. And just to reiterate, it's highlighted there, net. So everything in Theta Trader is net of all trading cost. What size of an account? That's really up to you, but it really needs a minimum of 25,000. Otherwise, you'll be restrained and constricted. You wouldn't really give it the best opportunity. Each Dragonfly has about a $5,000 margin requirement. Now, here's something people love. You can get a free membership. I just talked with someone late last night, said, I got to get this rebate. I'm going to do over 100,000. So absolutely. You have an account of 100,000 or more, we'll just rebate that membership fee. 50 to 100,000, we'll rebate 50% of that membership fee. So love to have you take advantage of that offer. We talked about IRA. You can do individual, joint, corporate, LLC, trust, all those typical types of accounts like any brokerage firm can offer. Now here we'll kind of wrap it up and get to some Q&A. But why would you want to use Theta Trader and non-correlated alternatives in your portfolio? Non-correlated meaning the performance of the asset doesn't necessarily reflect the general stock market, so that's what they mean by non-correlated. Well, it says here, alternatives whose performance has a low correlation to traditional investments may improve diversification and lower portfolio risk. And what is that risk? Well, part of the risk is inflation. Look at this. Back from 2000, here's the value of a dollar. Let's say it's 100 cents. Now, that same dollar is worth only about 56 cents, 56.9. Inflation outpacing wage growth, cutting into spending. Look at this here. Weekly earnings are rising, but meanwhile, when adjusted for inflation, they're actually negative 4.4%. So that's what that looks like here. Essentially, weekly wages adjusted for inflation. You can see you have less and less money in your pocket, folks, just like this cartoon summarizes. GDP forecast, we might be heading into recession. I mean, I think we're already there, and we're kind of looking at the next several quarters, 2 or 3 quarters in recession. Latest estimate, negative 1.2% forecasting. So that's where we're down here now, according to the Atlanta Fed. IMF cuts its global GDP, raises inflation outlook. Warns we're teetering on the edge of recession. That's from a couple of weeks ago. I think we're already there, but that's just me. Conference Board has their leading economic indicators declined for a 4th consecutive month, suggesting economic growth likely to slow further as recession risk grows. Forward-looking LEI points to U.S. economic downturn. Amid high inflation and rapidly tightening monetary supply, economic growth will continue to cool, and there's a recession around the end of this year and early next year is likely. So we shall see, but again, I think we're already there. Here, we're dipping negative now. And you can see these gray shaded areas. That's a recession. So any time in the past, these leading economic indicators turn negative. It looks like it always results in a recession soon after. Maybe not right here. There's a couple fake outs, but this here, the Fed is actively hiking rates. That's the blue line, while the GDP is contracting. So GDP is falling, and meanwhile rates are moving higher. And I think that's the first time in history where the Fed has raised rates during a recession, and we're into a technical recession right now. But in percentage terms, these Fed hikes are huge, folks. They're very, very big rate hikes in percentage terms. Credit card balances jumping highest in 20 years. Kind of says the same thing there. Don't need to beat that one to death. Savings rate continuing to evaporate, the lowest since August of 2009. That's another graph showing kind of the same thing. Basically, here's stagflation. You've got your economic forecast globally, world GDP here, and then inflation. So that's what you call stagflation. Not a good environment. You've got the yield curve, the 2-year, 10-year Treasury yield curve, signaling recession as well when it goes inverted or negative. When that happens, it has, I think, almost always historically resulted in a recession right around the corner. So 46 basis points, the biggest inversion since the year 2000. Look at this, new single family home price cratering almost 12%, worst in history, 2-month change. So new home prices were here, and look at this. That's quite a ramp up, and now you go up the staircase and down the elevator shaft, as they say. Recession dates according to ISM. I won't go into this ISM stuff. It's kind of wonky, but you can see everything's turning down, down, down. This is interesting. Minus 3.3% a year in the next decade, according to this indicator. It says the average household portfolio allocation to equities is a contrarian indicator. The historical correlation between the indicator and the stock market is negative 3.3%. So that's kind of the projection for the next decade, according to this one particular indicator. So we shall see. So we like what alternatives can do. That's why we are doing what we do, and people like what we're doing because of that. You don't have to rely on a market that just moves up all the time. And then why should you try to avoid any large drawdowns? Well, what are the benefits? Well, let's take a look. So for example, I see the red That's a market drawdown back in early 2000 and then 2008. And then you can see here, it took 6 years after the tech crash and then 5 years after the financial crisis to regain to prior highs. And that's actually kind of short because historically there are, here's 22 years of zero growth, 25 years. Here's an 11-year period where it rallied only 9%, 17 years here of 0%, just a lot of back and forth chop. So there are plenty of times in history, folks, where the stock market really from one point to another ends up going nowhere. And again, avoiding drawdowns, it's important. If you're down 40% on an account, you have to break even by getting a 67% return. So sometimes people forget that simple math. And here's an example for Bitcoin. If you're down 70% in Bitcoin, you have to be up 233% to get back to even. So that's a large hurdle. Goldman says that the 60-40 portfolio, stocks and bond portfolio, you end up in a lost decade with that 60-40 portfolio. It says here that 60-40 portfolio is getting clobbered this year, and I think we can all relate to that. There was nowhere to run to, nothing that was safe, so to speak. Bonds provided no protection. So do you want this? Do you want this? Or maybe something like this? So we think it makes sense for you to have something in that alternative pie, piece of the pie there, and we can be that piece of the pie. So again, just to summarize, Theta Trader, pre-selected spread trades. They can be non-directional or even directional in nature, it's up to you. Automated trade exits using the RTI, so we can make it convenient, no screen watching. And the one-touch trade alerts are very, very user-friendly, as you saw. And of course, you can tie it all together with personal coaching. 5 simple steps. You simply complete that order form. You'll get your Theta Trader login credentials. We'll send you a link to open your account, and then you fund the account and begin trading. Just that simple. And okay, we'll leave that there, and let's see if there's, I think I answered a lot of the questions that I was able to glance at. Yeah, people mentioned that some of the traders I mentioned, social media, they make YouTube videos and they spew out information and could blow up your account. Yeah, absolutely. Someone's asking about the return goal. Well, everyone, of course, is going to be different, but you can see on the Theta Trader dashboard for every particular Theta trade, you have your targeted annualized return and your targeted return on cash. So you can kind of use that as a guide. Yeah, someone wants to review the presentation. We can make that available. Yeah, and everyone has different results. Someone's asking about percentages of this and that, and but everything is self-directed, so everyone ends up with different results. Some people accept trades, some people don't, some people modify trades. So again, everyone has an individual account. This is not managed money. You open an account in your name with your own separate account number, just like any other brokerage firm, and you make the decision on what trades to place and when to get out of them. Yeah, the suggested account size, we kind of reviewed that. We suggest a minimum of 50,000. If you do 100,000 or more, you'll get a full rebate of that membership fee. So hopefully answers that question. And let's see if there's anything else. Any other questions here, folks? I see some other questions that we just talked about. Yeah, quite simply what you do is, let me just go back here. You just follow these 5 steps, and that's how you get started. Very, very simple. And again, there is that 30-day money back guarantee that's available as well. And yeah, you can use what people do. Someone's asking about demo. Yeah, you don't have to trade right away. So you can sign up, become a member, and then you can use Theta Trader in demo mode. That's perfectly acceptable. you don't, there's no rule that says you have to immediately start trading and fund the account. So we've had people sign up before and use demo mode for a while, or maybe give it a couple, 2 or 3 months, maybe they're busy, and then they fund the account and start trading. So you're not forced to trade at any particular time. Someone's asking about covered spreads here, unless you hold shares. Well, you're kind of referring to, when you say covered, I think you're referring to how they refer to that term and utilize that term with trading on like covered calls on a stock or something. So what we're talking about is these are covered spreads, meaning any particular option that you sell has an equivalent number of options that you buy at a different strike price that will act to cover you from unlimited risk. So that's what you're talking about when you say covered option spreads. It's a different vernacular, slightly kind of a different subtle meaning when it comes to saying, covered. Someone who's trading stocks might say, I'm doing covered calls. But that doesn't mean anything in our industry here, or the space that we're in the sense, because we don't own any stock, and we're not selling options against a stock. Again, we're just doing options on the futures index. So that's one way to look at it. We're just trading one option versus another, and that's what we mean by covered. So hopefully that answers the question. Yeah. You want to cover yourself from unlimited risk. That's the whole idea. So your risk is predetermined and your reward is predetermined in advance. And that's the benefit of having these types of strategies working for you. Anyone else want to see anything else? I can jump back into the demo if you want. I can show you the dashboard again. Any other comments or questions? All right, I think I covered everything. And well, while I've got just another minute. I know we've been on for a while, but let me just do one thing real quickly. Let me jump screens real quickly. I'll go back to the dashboard. Yep, okay, you're seeing the dashboard. And again, have any other further comments or questions, write those in. I'm still kind of paying attention with one eye. So again, on the dashboard, very simply put, you would log in, you'd say, what are the bullish strategies or bearish or neutral for the day? And again, you can trade the NASDAQ 100, Russell 2000, or the Emini S&P 500. These are all E-minis. And you might want to have a difference of markets because they're highly correlated, but not fully correlated. Sometimes there might be only an 80% correlation or 90% correlation between, the Russell, versus the ES. So if you wanted to do a NASDAQ position, maybe you're bearish on the NASDAQ, and maybe it's you think you're going to get a down move in the next 2 weeks, or maybe by the end of the month. So we'll do this August end of month. Here's a bear hedge. Someone's asking, yeah, we do trade futures, of course, absolutely. So you can trade ES futures. We're a full service brokerage firm, but this happens to be our platform for option spreads. But yeah, certainly you can trade any futures contract with us if you like. It just wouldn't be with Theta Trader. But good question. Right, so here's this example of a bear hedge on the NASDAQ. So you sell this call spread, use the money to buy a put spread. And you could do maybe a quantity of 2 of these, whatever it might be. And you place that order. And then it just shows up on your dashboard as a put spread and a call spread. And then of course from there, the RTI can automatically track that and monitor that for you. It's not going to do anything with the long spread. Actually, some people have asked that in the past, so I might as well just mention that. The long spread, of course, has limited risk anyway, very minimal risk. So the RTI is really only there to mitigate the risk and manage the profits on the short spreads. And you can see how, yeah, here's the one we just placed, the end of month NASDAQ. Oh, here's another feature too, just hover your mouse, you get these pop-ups. So if you don't fully understand all these symbols yet, you will, but you can just use that pop-up to help you. But having a bunch of orange or whatever RTIs on some long spreads is not uncommon. In fact, that's quite common. And if you really wanted to, some people ask, can I make my own trades? Yes. For example, we'll just kind of pick a random Condor here. Give it just a second. So again, you can modify these strikes. You can see the chart here, but if you want to move the strikes a little bit, you can. So you want to sell, the 38 puts and move the strikes up maybe 20 points or something like that. You can see here the deltas now change. And of course the value of the trade changes and all that. So you can always change it if you'd like. But most people don't. Some people do, but most people don't. All right, and I think that's going to wrap it up. I'll let you get going. And I know that oftentimes as I'm talking, I get other people calling and forwarding to other people in voicemail. So this is a good time to call. Don't worry about if I can't pick up right away. Just give me a call anyway. We'll get you taken care of and use that link right there. Get you set up, get you signed up. And again, don't feel like you're obligated to something. Again, 30-day guarantee on that. So we've never had any problems with that. Some people asked, well, what if it's 31 days? Well, that's fine. So again, that's not our business. All right, any other comments or questions, anyone? I'll switch gears here, show you that last slide again. Okay. I think that's going to wrap it up for us. And with that said, I'll let you get going. Thanks for joining me. And I look forward to answering your questions and hearing your comments. I love getting feedback. Send me all the feedback, good, bad, or otherwise. Really, it helps us improve these presentations. And we'll let you go. We got a lot of work to do, and I'm sure you do too. All right, thanks for joining us. Bye-bye.